I'm glad to have your perspective here on what does and what doesn't matter for growth stocks and their relative performance. I see that you're with me on this idea that higher interest rates in themselves don't really explain much of the story with growth stock valuations, the boom bust that we've seen so far. But what do you think mostly has been driving things? I mean, we have this massive relative peak in growth back in November. It's been a tough 4 months.
It's certainly been a tough 4 months. I think this narrative that growth stocks are somehow interest sensitive and the higher rates go, the worse it is for growth stocks. It's just certainly been true probably since the fourth quarter of 16, but historically it hasn't been true. There's been a positive correlation with higher rates and growth stocks. So, I think a lot got lumped into the growth stock category. A lot of science experiments, no revenue, no earnings companies, a lot of just absolutely atrocious things that were thrown into SPACs, which everyone ran around and called growth stocks. But I think that shakeout has happened. And, typically growth stocks have had a positive correlation to rising interest rates and a stronger economy. So I know there's a narrative going around that, the higher rates go, the higher the discount rate is, and that means growth stocks are worth less. I mean, that's an answer you'd expect from a first-year business student, and even worse, perhaps one of their professors. But fundamentally, it isn't true, and seemingly intelligent people have reiterated it. So I'm not sure where it comes from. What matters most is the strength and the duration of that E, or that earnings growth. And thus far, we've seen through earnings season some fairly strong growth, and the economy remains, to this point anyway, fairly strong.
Well, where does that leave you in terms of just looking for stocks either that have been, way too punished or stuff to stay away from? You were saying before, the average pullback in a NASDAQ stock is close to 50% from high to low.
Yeah. Look, I mean, I've been running the same fund now since the late 1990s. And so what's gotten me through every bear market I've been through is companies with actual revenues and actual earnings are the first place to start. And there are quite a few with a number of secular growth trends. Having said that, there was obviously a big surge in work from home stocks, for example. But even in some of those companies, there are companies that were trading a year and a half ago at 50 times revenues that now trade at 25 times earnings. So, I would say that, continue to focus in on the secular names with revenue, with earnings. But there's so much carnage, especially in some of the other stuff, with actually pretty good companies, that some of those, especially the ones that, that's 50 times revenues, don't look at it. I go, actually, if you look at it now, it's trading at 25 times earnings. Some of those stocks that were in the work from home space have been absolutely decimated. So always start with revenue and earnings and companies that are continuing to grow, for sure.